Be Wealthy and Smart, episode 906.
Step into a world of wealth and financial freedom without budgets, boredom, or bosses on Be Wealthy and Smart. And now, here's your host, Linda P. Jones.
Welcome to Be Wealthy and Smart. I'm Linda P. Jones, America's Wealth Mentor, empowering women and men worldwide to financial freedom. On today's show, we're going to talk about mortgage rates dropping to a new 5-month low. This is one of the best times I've ever seen to refinance your mortgage. Mortgage rates have not even bottomed yet. Interest rates are trending down. I've said a while ago that we may even see negative interest rates, but what we're seeing right now is effectively a negative interest rate, because when you have inflation at 5+%, some people say 13%. If you listen to John Williams at shadowstats.com, as I've mentioned to you before, with the real numbers the way they used to be calculated, but let's just say we're taking 5% as our inflation number right now. With interest rates where they are, you could argue that we are already at a negative, possibly 4% interest rate, because we are behind the 8 ball when it comes to inflation. So when interest rates are so far below the inflation rate, essentially you have a negative cost of money. So I want to share with you this article from Yahoo Finance, written by Clayton Jarvis, about mortgage rates. And it says, mortgage rates have fallen for a third consecutive week, making refinances an even more attractive proposition for millions of U.S. homeowners who are still sitting on older and costlier loans. Average rates on 30-year home loans dropped even further below the 3% mark last week to a new 5-month low, a leading survey says. Today's mortgage rates can provide a typical refinancer with hundreds of dollars in monthly savings, according to other new data. The average interest rate on America's favorite home loan, the 30-year fixed mortgage, dipped last week from 2.9% to 2.88%, mortgage giant Freddie Mac reported on Thursday. I just want to pause there and say, can you believe we're talking about a 2.88% 30-year mortgage? This is crazy, and I love it. And if you haven't refinanced, this is the time to do it. You can save thousands of dollars annually on your mortgage potentially, as well as thousands of dollars over the 30-year period of time on your mortgage. And as you know, I prefer the 30-year mortgage to a 15-year mortgage. It gives you more flexibility, it gives you lower payment, better cash flow, and you can always pay extra payments or one extra payment a year, and that will cut your mortgage down substantially in time. So you have a lot of flexibility if you take the 30-year mortgage. The article goes on to say rates are the lowest since the week of February 18th, and 30-year mortgages are even cheaper than they were a year ago, during some of the darkest days of COVID-19 when the average rate was 2.98%. Since their peak at 3.18% in April, mortgage rates have declined by 30 basis points, that's 0.30%, notes Sam Cotter, Freddie Mac's chief economist. A basis point is 1/100th of 1 percentage point. Despite the ongoing declines, today's rates under 3% are unlikely to last, experts say. As the economy shakes off the effects of the coronavirus crisis, it may be only a matter of time before the Federal Reserve begins reducing its pandemic management strategies, including holding interest rates at historic lows. Homeowners and buyers should not get too complacent thinking that 30-year rates will stay below 3%. Corey Burr, Senior Vice President at TTR Sotheby's Real Estate, tells MoneyWise. They should act now to refinance if it makes economic sense for them. The average rate on a 15-year fixed-rate mortgage saw a modest increase last week, rising from 2.2% to 2.22%. But 15-year loans are considerably cheaper than they were at this time last year when the average rate was 2.48%. The low cost of fixed-rate mortgages matches the low yields or interest on 10-year Treasury bonds. Once those yields begin ticking upward, fixed mortgage rates are likely to follow suit. But one ongoing Fed measure could help hold down bond yields and mortgage rates. To support the economic recovery, the central bank each month is expected to keep buying up at least $40 billion in mortgage-backed securities, which are investments made of bundles of home loans. In short, the Fed thinks that there is still work to do to get the economy back on track, which will keep mortgage rates low for the remainder of the year, says Realtor.com senior economist George Radiu. Freddie Mac just adjusted its forecast for 2021 and now looks for 30-year fixed mortgage rates to average 3.1% throughout this year, down from its April prediction of 3.2%. Rates on 5/1 adjustable rate mortgages, or ARMs, last week were averaging 2.47%, down from 2.52% the week before. At the same time a year ago, the 5/1 ARM averaged 3.06%. And I just want to pause there and say, I don't recommend that you get involved in adjustable rate mortgages for any reason, because we could have interest rates spike at any time. So you want to lock in these low fixed mortgage rates. The article goes on to say ARMs typically come with cheaper rates than those attached to fixed rate loans at the outset anyway. After an initial fixed rate phase, the interest rate adjusts in line with the prime rate or some other benchmark. A 5/1 ARM has a 5-year fixed rate period followed by adjustments every 1 year after that. Because the rate can move up or down, adjustable rate mortgages can sometimes be hard to budget around. Given the past year's historically low mortgage rates, you might assume that homeowners have been flooding their lenders with refinance applications, but that hasn't been the case. A survey conducted by real estate platform Zillow found only 22% of eligible homeowners refinanced their mortgages between April 2020 and April 2021. Almost half of them saved $300 or more a month with a refi. New figures from the mortgage data and technology firm Black Knight show that with 30-year rates at their current levels, 13.9 million homeowners could save an average of $293 a month by refinancing their homes. If you're a homeowner who's been putting off refinancing, don't be intimidated by the process. Start by gathering and comparing mortgage offers from at least 5 lenders. From that point on, you won't have anything to do more complicated than what you had to do when you took out your original mortgage. When you apply for a loan, for either a refi or a home purchase, lenders will look carefully at your creditworthiness. Today, it's easy to check your credit score for free to see if you need to boost it before you start approaching lenders. The higher your credit score, the lower your mortgage rate is likely to be. And if you ultimately rule out a refi, you might lower the cost of homeownership by scoring a better deal on your homeowner's insurance. A little comparison shopping is all you need to find out if you're overpaying. The same strategy could save you hundreds of dollars a year on car insurance too. End of article. So I want to say that if you are looking to improve your credit score, I have lots of podcasts on my website at lindapjones.com/podcasts. Many more podcasts there than are on Apple Podcasts. So check out all of my good strategies for raising your credit scores. Super easy, super simple to do, and lots of people have had great success raising their credit scores. Also, if you want to know more about why I recommend a 30-year mortgage, not an ARM, and not a 15-year mortgage, I wrote about that in detail in my book, You're Already a Wealth Heiress, Now Think and Act Like One, 6 Practical Steps to Make It a Reality Now. In that book, I talked about specific financial steps, tips, and tricks that you can do to not only get your portfolio to $1 million, but also some smart financial strategies that you can use in your everyday life. The Wealth Heiress book was added to the list of all-time best wealth books by Book Authority, and you can find it on Amazon.com, Amazon.uk, or any fine bookstore. One last comment, and that is that if you haven't refinanced your loan, if there is some reason that you think you didn't have enough income, or you have your own business and you had too many deductions. There's all kinds of different types of loans, and lenders are willing to work with you. And now it's easier than ever to apply for loans online. So you can go to some different loan websites, and oftentimes you can apply once and 5 or more lenders will contact you and want to work with you to try and give you a quote. So you'll be able to figure out which lender is best for you, depending on what your needs are, what your income issues are, if any, and what it is that you're really looking for. So this is the time that you can save thousands of dollars. Don't miss these low interest rates. This might be the time where you can lock in the lowest interest rate of your life for the rest of your home's mortgage. I mean, how great would it be to have a 2% mortgage for 30 years? At 2% interest, it takes 36 years for the amount of the debt to double. It's a very slow growing mortgage. It's also, of course, tax deductible, and there is nothing wrong with home mortgage debt, especially at these interest rates under 3% in many cases. So don't wait, lock in these really low rates. Don't miss this opportunity. This year might be the last time that we see low rates like this. So this is the time to really get everything together and talk to some lenders. When I saw this article, I thought this is the most important topic that I need to bring up on the podcast. I always find that one article that I think you really need to know. And in this case, this is one of the most important for your financial future. What you pay on your home and whether you have a mortgage or not is a huge deal. When money is only costing 2% a year and it's tax deductible, there is nothing wrong with home mortgage debt. Nothing at all. It's the high interest credit card debt that you want to stay away from. And what's great is that oftentimes if you have enough equity in your home, you can use that to pay off those high interest credit cards and get rid of them. Lenders are more than happy to work with you to consolidate your debt, and or if you have a low balance and you want to take out some equity and do a little remodeling on your home, you can do that too. And at a 2% interest rate or under 3%, that's just low cost credit that really you should consider. And don't feel guilty about having debt when you're only paying 2 or 3% and net of income taxes less than that. So be smart with your finances to use cheap money. That's all for today. Until next time, live the good life and be wealthy and smart.
Thank you for listening to Be Wealthy and Smart with Linda P. Jones. Share the wealth and tell your family and friends about the show. Check out our website, blog, and social media for more riches at www.bewealthyandsmart.com.